Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And this is the interview I teased this morning on the Daily Financial News. I have someone that looks at the housing market probably more than me. And let's just say that is hard to do. Let's welcome Lance to the show. How you doing, buddy?
Hey, doing good, Michael. Really appreciate you reaching out.
Well, do me a favor, introduce yourself to the audience and why I say with confidence, you actually may look at the housing market more than me.
Yeah, so I'm an editor at Fortune Magazine. I have my own newsletter called Fortune Analytics that goes out each week to an executive type crowd.
Mhm.
But before coming to Fortune Magazine, I had worked at Realtor.com for a couple of years analyzing housing data. And at the time, we always talked about the fact that towards the end of the decade, coming into the 2020s, there would be this big rush of millennials into the housing market.
Mhm.
Those born between 1989 and 1993 are the 5 largest birth years for millennials. And they all hit the age of 30 between 2019 and 2023. So even when I was coming into Fortune, I told them, hey, I'm probably going to slide a little bit into the housing stuff over time if this, theory actually plays out. And of course, not only did it play out, but that wasn't even necessarily all that was driving it. We had the perfect storm of the pandemic housing boom.
Mhm.
And in my view of the housing market is I feel like this cycle, you can kind of see where we are headed for the bigger economic cycle by
Mhm.
looking through housing.
I agree.
We hear the narrative of the supply chain constraints, the shocks from the lockdowns, but I also believe there's an underlooked aspect to the inflationary side, which is demand.
Yeah.
And we have unleashed a lot of demand. And where you can see that is the housing market. And of course, the boom in the housing market and all the movement across states and the new construction, which we went up to 1.8 million housing starts, that actually put strain on the supply chain. The supply chain could never catch up because as soon as the lockdowns were kind of lifted, boom, the work from home migration was off to the races.
Yeah.
And I lived in New York for a few years, my wife and we had a 3-year-old. And we're among the people that left New York. We came to Cincinnati, built a house in the summer of 2020. Coming from a small New York apartment, we had to buy everything.
Yeah, exactly. Yeah. You mean you need more than one couch? Yeah.
And we actually threw our couch out. We left
Exactly.
it.
Of course. Why would you? That doesn't match the new furniture. It's a different quality. I get it. Yes.
We left it in a foot of snow. Nobody would come pick it up. And so we had to get all new furnishing. And so the work from home migration, I believe, was always overlooked. And I think it put a lot of stress on the whole supply chain.
Yeah.
And before I get into my view of housing, which I've had coming into this year, a little more of a bearish view, because I think the housing cycle was going to get broken by the Fed's inflation fight. But before I get into it, I just want to say that we have just lived through perhaps one of the most valuable periods ever for home ownership.
Yeah.
You look at the appreciation side, US, we've gone up 42% with home values during the pandemic, but it's the other side of it. Homeowners, unlike renters, are more protected from inflation.
Yeah.
And you look back at history in the 1970s, from the beginning of the 1970s to the end, inflation went up 100%. The S&P 500 went up 10%. That's not annualized. That's the whole decade.
Yeah. That's the decade. Yeah.
And US home prices went up 160%, and rents were up like 120 or 110. I'd have to go back and look at it. But,
Yeah.
So now when we look at the data and we see that we have become fundamentally detached from home prices, and so you have some people worried about some type of crash or something like that.
Sure.
The thing that I would say to people is, would you rather be somebody going into the 70s as a renter, or would you rather be a homeowner about to ride out 08?
Yeah.
I'd rather be a homeowner riding out 08.
Yeah, because again, your debt doesn't change. You've got fixed rate debt, all of this stuff. So it's funny you bring all of this up. There's kind of 3 themes, and we'll go in any order you would like. First theme, I actually produced for my channel over a year ago what's now called the 52-year spreadsheet. I went back to 1970 and documented all kind of economic factors. And the first time I introduced this spreadsheet, which I give away for free, by the way, it's all sourced and all this stuff, is I said the people that won the 70s are people who bought a house in 1970. It was the lowest interest rate of the decade. It was fixed for 30 years. Prices doubled, right? More, 106, but prices doubled. So your balance sheet went up. If you're renting it, rents doubled. So that's, NOI and, cash flow doubled. So more than doubled, right? Because that was all net positive. So same idea, right? I actually created a shirt that says, and I'm looking right at it, I use inflation to get rich. Ask me how.
And I'm right there with you. And if you look at what happened at the conclusion of that whole period, which it concluded finally with a third recession in 81, 82. Mortgage rates got to 18%. We only very briefly had a nominal home price decline year over year.
We had a couple of real housing declines, but that's not what most people look at. It's all nominal. That was definitely a conversation. There's a big difference between real and nominal, which I try to educate people on.
And so we've been detached from fundamentals 3 times. That period, very brief nominal decline. And then we had the real, so income and inflation grew faster than house prices. And that helped to get the fundamentals back in line and helped to grow the next housing cycle. And then we had the '08, which really, I still kind of see as a once in 100-year episode.
I hope so.
Yes. and homeowners are in a much better financial state now. We don't necessarily have the credit and debt issues that we had then. So I don't think there's any reason to think it's that. And then we have now our current episode. So it's a question mark of where do we go next?
Yeah.
And
I would love to talk about that. Again, I think there's, Lance, I think there's definitely a chance that we have a real pricing decline if you look at over the next 3 to 5 years. But I don't see a nominal. It'll be relatively flat. But let's get to that. Let's kind of end on that because I think that's where the money is. I have 2 other things that I believe at the core, and I'll give you both, and then we'll talk about whichever one you want to talk about first. One is I've adapted the mindset that the Fed broke the housing market. 2, I believe we are entering a housing depression. So both of those are meant to be kind of thought-provoking. Which one of those 2 do you want to dive in first? The Fed broke housing or a housing depression?
Well, and so I don't know, when you say Fed broke housing, I don't know if you meant.
Well, I'll define them. Whichever one interests you, I'll define them. You're not supposed to.
How you view it. If you mean they broke the current housing cycle we're in, yes. And then all of the housing cycles, and this probably goes to the point you're saying, all the housing cycles are related to inflation, related to unemployment, related to the business cycle. And the housing cycle has been morphed over time based on how the Fed,
So I think it's a little, I don't know, either more subtle or more important than all, because all that is true, Lance. This is what I mean by the Fed broke housing. Just kind of lay it out for you. So for all of my adult life, and I've been looking at the housing market for 30 years, at the base value, it goes like this. First-time homeowner, they buy the home, they're single, they're married, no kids. They fool around, they make babies. At some point, they have a move up, right? They make more money. And at some point, they go from a move up to luxury, right? There's a general trend of how housing behaves as we get older, right? You talked about millennials in your introduction, aging into first-time homeownership. Why do I mean the Fed broke housing? I think the Fed broke housing, the natural cycle of housing, for 5 to 8 years. Why do I say that? Well, as I'm sure you know, a large percentage of homeowners in the residential space have a mortgage with a 2 on it now. It's estimated.
I see where you're going now. When I bought this house, if I would have known how everything would play out, I would have bought a bigger house.
Exactly.
We have 2 kids now. We have 3 bedrooms. I would have gotten a 4th bedroom because now I'm not moving.
Exactly. You're going to buy bunk beds.
Yeah, you're right.
Exactly.
We now have a boy and a girl. And we're going to bunk bed whichever.
I'm telling you, folks, this is happening. Invest in bunk beds. Nobody's moving.
So I see what your point is. Yeah, because why would I give up a 2.6% mortgage rate?
I've been talking about this for 6 months. The Fed broke housing. Now what's going to happen is it used to be, hey, one life event, because for 40 years, as you know, rates got cheaper. So the move up home was not as painful because the rates came down, generally speaking. Yes, it was pricier, but you took the equity, you moved in, the payment wasn't great. I've had people do the math with me on my channel. The payment most of the time, Lance, is up 100%. Sometimes it's up 200%. The Fed broke housing. Not only do we have a first-time homeownership problem, because now we have 18 million people that can't qualify at 6 that could at 3 problem. Second, Lance isn't going to move. Lance is going to buy bunk beds, which, Lance, that's 2 homes you're not selling and you're not buying. That's Fed broke housing. That's what I think.
Yeah. So I see what you mean there. And yeah, it'll be interesting to see how it plays out and where mortgage rates move to. I think first of all, we don't know if this inflationary cycle is going to break very quickly. There's a chance, it's going to go down. That has to happen. The Fed has the power to make it go down. But what if it's more entrenched and it comes back in the future? That scenario, which if we go into a recession, and it looks like a lot of the indications are pointing to, we will probably go into one, mortgage rates will probably end up coming down a bit. But if we are in a sticky inflationary cycle and inflation comes back, that means we're moving into this period where over 5% rates is going to stay around. And that's where you're probably right, where we have locked a lot of people down. Now, from the economic side of it, it's a little less worrying because people now with the work from home, actually the work from home coupled with low rates locks people down even more.
Exactly.
That's what I think about it. Yeah.
It's definitely, it's broken, man. Broken.
Yeah. Wow. I didn't, that's an interesting point.
Yeah. So again, I think Fed broke housing, and I think it's the normal natural is like 5 to 8 years. People kind of start moving. It's now going to be 2 or 3 life events before you, like if you have another kid, like right now you're going bunk beds, but if for whatever reason you have another kid and she has twins, you're going to be forced to move, right? It's going to be an uncomfortable situation that causes people to move because it might happen. But in reality, you probably rent this home. You don't sell it because you cash flow like a monster. So that's my statement. The Fed broke housing. Now, number 2, I believe housing is going to enter a depression, a nuclear winter.
Like, are we talking about sales?
See, now you're catching on, right? You got to be very careful. Absolutely, transactions. Go back and look at history. We have had a time where rates doubled before. It was in the late 70s, early 80s. And just like last time, we are going to see peak to trough a crash in transactions of 50%, give or take. That is going, if your income is reliant on transactions, it is going to feel like a depression. GDP made up of the housing market, as you know, is about 15%. If we lose 4% and the housing market, it's going to drag the economy into a recession. So I believe we are not in a first half recession, even though both quarters were negative. I have an econ degree. It's more sophisticated than that. However, I believe the housing market is falling apart so fast that the recession started July 1st. It won't be called until January or February, but I believe the recession, calling it right now on July 28th, will be labeled Q3, Q4. And more importantly, it will be housing market led. You can't lose 50% of transactions. You can't have 83% collapse in refis. The liquidity is coming out of the market. Everybody who wets their beak in housing is going to have to live on ramen noodles. It's going to be bad. And that's what I see coming. That's what I mean. Housing depression.
And my Twitter profile, my description, it just says works at Fortune magazine and housing is the business cycle. And I think a lot of people have forgotten how important housing is, especially when the Fed moves into an inflationary fight. A normal Fed-induced recession, or actually a normal recession, is historically speaking Fed-induced, and they do it by breaking the housing cycle. That's a normal recession. And actually, we have not had a normal recession this whole century. The dot-com boom. Now, you could say 05, 08, but really that wasn't the Fed breaking the housing cycle. Housing broke itself.
No, I agree. Housing broke itself.
And then, the COVID-19 lockdowns. And so this is kind of this is the norms of history. And now some will point out, okay, that 15% GDP number you have there, that's a little more broad, and that
Sure.
there's the residential real estate
Mhm.
investment, which is 3 to 5. And
Okay.
people keep saying 3 to 5, it's really small. But right there tells you the story. It's 3 to 5 because it's 5 during the growth periods and it's 3 in the recessions. And that contraction, that loss of that GDP, and as it spills over into the rest of the economy, brings it down. And so this is why coming into this year, I was more bearish on housing.
Mhm.
And I started to really get into the fundamental research about the overvaluation, because all of that stuff becomes much more important once the housing cycle is broken.
Mhm.
And so where I kind of am is that, yes, you're right. I think we're barreling towards a Fed-induced recession. I think it's a little stalled because there's so many homes under construction, and the drop in activity on mortgages and sales isn't really necessarily what starts the contractions through the rest of the economy. It's construction.
Mm.
They have to put the builders on their ass.
Oh, they
If
are.
that-
And it has started. John Burns Real Estate Consulting, as you know, does a monthly survey. They're starting to lay people off. It's coming, right? And
Yeah, it's
call
coming, but it's been delayed a little bit.
Sure.
Like we've
Agreed.
already been barreling, like the mortgage industry's already felt it, the real
Oh,
estate agents have felt it, and the builders, their sales have been plummeting.
yeah,
But as they actually finish up these projects, which there's a lot out there,
there is. But
not
there,
as
yeah.
much as they could have had if there wasn't the supply constraints, and that's something that John Burns Real Estate Consulting has pointed out.
Yeah,
Is that could have
they
been,
saved them. Yeah.
yeah, it could have saved him. And so, yeah, I think it barrels through housing. I think it's a little delayed,
Mhm.
but everything that you look at the numbers, it looks like we're pre-recession,
Mhm.
or maybe it's going to get called back to this period.
Yeah. That's
But
my call is I like to try to call things early because when you write, you look amazing. When you're a fool, I'm okay looking like a fool. I think the recession will be called Q3, Q4, and I'm calling that really early, obviously.
yeah, I think a lot of the data looks close to that. And so now that's the easy calls, right?
Yeah. Now, come on. Give me
The
some
hard
credit.
call, and this is the debate, is
Yeah.
the nominal prices. Could
True.
we get nominal price declines? And that's the tricky question.
Yeah. Let's talk about it.
Um, and so where we kind of are right now with the forecast, Zillow's super bullish. They think
Yeah.
it's 7%.
They're wrong.
Freddie Mac, Freddie Mac is 4% year over year,
Mhm.
which probably means you still get Boise down year over
Yes.
year.
Boise's a bubble. Yep.
Mortgage Bankers Association is like around 3 to 4, but if you cut their analysis down, you can see that they actually have prices Q4 2023 lower than Q2 2022.
Okay.
And so you don't get the year over year, but you you
Yeah. It's kind of, that's
they
the
drop,
beauty of year over year. Yeah. Yeah. I
yeah, they
understand.
drop over a 16-month period.
Yeah.
And Goldman Sachs is 1.8 year over year, which I'm guessing theirs is probably just like Mortgage Bankers Association. They think the end of 2023 prices are probably lower than Q2 2022.
Mhm.
And then you do have, and then you have, well, Bill McBride, who's kind of not making a call necessarily, but says he thinks it goes flatline just
Mhm.
based off of history. And I
Mhm.
think that call makes a lot of sense.
I think so too.
You have Ivy Zellman, who's 3% year over year. Now, this is where you start getting to where you're getting some serious regional drops if we have 3%
Yes.
year over year
Agreed.
nationally. Moody's is 0, but they go to 5 if recession comes. And so that's kind of like just saying you're down 5.
Yeah, exactly. What? Yeah. Down 5. Yep.
And Moody's is 5 to 10% in overvalued markets. So any market that is overvalued by more than 25%, which is a huge
It's a
portion.
good, yeah, it's a good chunk. It's got to be 50% of
And if
market.
it's recession, it's 15 to 20% year over year. And so that's Moody's. And then John Burns Real Estate Consulting won't give the numerical figures. I've seen
Yeah.
some of them, other people have seen them, but
Yeah.
I would say they're bearish. They've even kind of admitted maybe more bearish than Moody's, but
Yeah. Gotcha.
and so there's a lot of calls out there, but and you look at history, it's very possible we get a nominal year over year decline. I think just the problem here is a lot of people think housing crash, '08, and we don't have those dynamics.
There's no setup.
We don't have those dynamics.
Where's the forced seller coming from? Right?
Yeah,
The cascading forced seller.
You have to have the debt issues, and then you have to have the terrible economic issues. And GFC, we call it recession, Great Recession. That was a depression.
Yeah, certainly in the housing it was. Yeah.
That was a depression.
Dude, my market went down 75%. You bet your ass it was a depression. Yeah.
Yeah. Now, reversely, I think some of those, because they're like, okay, we don't have those dynamics, are kind of ruling out the possibility of nominal declines. And even almost, and I don't think they should necessarily be afraid of nominal declines. I think if we get nominal declines and it kind of helps with the fundamentals a little bit, nothing crazy. Maybe it's 5-10% in some of these bubbling markets. Maybe it's 15. That helps with the fundamentals. And there's a lot of sideline demand happening now. Yes, you're right that there's people locked down, but there's pent up demand that's going to be here. A lot of these millennials still got to buy, and we still need more homes. We need more homes. And so I think that a nominal decline plus all of these other factors could set us up for a really, a good housing cycle past this one. But those who don't think this one's broken, who don't think that this housing cycle has turned over, you're going to continue to get more and more of a rude awakening through the year. And keep in mind, inflation, the latest reading, is still 9%. So the fight's not over. Yeah.
So I think there's a couple of things that I just like to share my opinion, because you can point out where the holes are. So a couple of things. Again, I've studied housing pretty in depth for 30 years. First and foremost, this is going to end up on YouTube in my podcast. There's a lot of YouTube channels, as I'm sure you know, calling for 25-30% crash in a single year. I've studied housing for a long time, and even the real inflation crashes of 79 to 82, 85 to 87 SNL, these were years in the making. The largest nominal pricing decline in my 52-year spreadsheet, I believe, was 2008. It might have been 2009, and that was 8.9% nominal, right? So again, the chances of a double-digit price decline, median, national, not very good if you want to call it for one 12-month period. Just not. If you can't take the most recessionary, depressionary resets and nega am loans and just real estate stupidity and get a double-digit decline nationally, I don't see how that happens. Could we have a nominal decline of 10% over years? Sure, I have no idea. But the chances inside a 12-month period, giving 52 years of history, not likely. So that's why I think about that.
Yeah.
Go ahead.
Prices are sticky. Sellers don't
exactly.
There's a psychological issue to it. If there wasn't the psychological side of it, then it would probably.
It's a different game.
Yeah, but there's a psychological. You don't want to.
That's called price elasticity for all those people that want to look up some econ terms. It's emotional, and you got to live somewhere, right? If you sell your home, back to your point of you're not moving, if you sell your home because you had another kid, you got to buy something else. And you're not going to triple your mortgage payment. So back to my thoughts about housing. So again, I focus on the median. So I buy in one market of Fresno, California. I know that market like the back of my hand. And then I live in the Bay Area, so I know the Silicon Valley. Okay. And then I talk nationally because that's all I can talk about, right? I don't know Boise, Austin, Nashville. So I have to talk nationally. So the chances that the national median home price goes negative in 2022, not happening.
Oh, it's impossible.
It's impossible.
Race all the spring and get back to this December. Yeah.
But you say that like that's like no duh, but there are people calling for a crash, nominal crash in November. They just are. I don't know how they get there.
Well, the whole process to a crash would be, buyers back off, sales go down as mortgage rates went up. And then from there, builders cut back. And then you kind of had to get all the way through to where inventory has built up. There's actually a recession. People there's a long process to get to a crash. So even if the crash came,
it ain't happening this year.
Longer, it would have. This would be like 05, 06, and you would still have.
Yes, exactly.
Yes,
exactly.
So
So now let's talk about 2023 because that's at least an interesting discussion. Because 2022 is impossible. Stop bringing it up. 2023 is interesting. And this goes back to my first statement, the aha moment of the Fed broke housing. I think we're going to have I think we're going to have a 1981-82 crash in transactions, 50% in new homes, 50% in existing. That's a problem. That will lead to the national economy being in a recession.
Mhm.
But I believe with so many people stuck, by the way, we still have 3.6% unemployment. Even if that goes to 5%, that's still historically great. You're just not going to get that cascading of forced sellers. So I don't see how nominal prices decline. I am kind of in the flat camp, +1, +2, flat. Real, I think we have a real housing decline because I think inflation is north of 5% next year. And if you want to talk about nominal housing crash in 2024, that gets even more interesting. Certainly possible. But it's just so slow. I think it's going to be super slow.
We ignore the risk on inflation too, because what if it's 76, 77, where, and it comes back. And so what have we unleashed? And so I'm very hesitant on the predictions. And where I am is just, I came into the year bullish or bearish on the housing cycle, because in November, after a few months of inflation going down, it swung back up.
Mm-hmm.
And so everything in history at that point, if you look at the data, and I'd be happy to share the chart from November, it looks like the Fed would go into inflation fighting mode, break the housing cycle, go into recession.
Yeah.
And so now I'm not going to back off of that because, it's like,
yeah, the call's out there. You're right.
Yeah. So but the nominal home price stuff is, I do a lot of writing on it. I look into it. People want to read about it. They're worried about it.
Mm-hmm.
And I'm, I think there's bubbly markets. And
sure.
if
No question
does get tamed, we get recession. I think these places get some big numbered nominal declines.
Yeah.
But that might not even really take them that far back in time.
Yeah, exactly. You go back to 2020 or something. But again,
and if those people bought back then at a 3.1 rate,
they're still ahead of the game.
Yeah. So, so to really have this to where it was a bad decision to buy over the past year or two, we'd have to really have a deep crash. And,
no,
it's just it's historically incredibly rare. And and so that's where I am there. I do think nominal price declines though are possible.
Yeah, I think it's market specific, right? I tell everybody to get their buy box. Again, my buy box is Fresno, California. We can talk about any like that market in detail, and then I go national. There's no national housing decline. I've been pointing at Boise specifically for like 9 months. Like that's a problem, right? You can't have all this California money raining down. Then they have the worst winter ever, and people boomerang out. It's just a supply demand mismatch.
And for them, there's a double whammy of rate sensitive, because not only were they well, first of all, the prices there, even before the rate hikes, were out of the locals.
Out of the local demand. Yeah, exactly.
Yes. And then now with the rates, you're starting to price out some of the people coming in.
Exactly.
Or at least take away the drawl of Boise, which was part of the affordability was a part of it. The bank,
of course.
But they're double whammy of rate sensitive because so many people coming there work in tech.
Yeah, exactly right. Yeah.
So incredibly rate sensitive. And they were even slowing a little bit before the spring, if you go back and really look at the numbers.
Yeah.
But I think some of the things that are interesting with housing is less of the looking forward, because it's so hard to predict.
Oh,
and,
of course.
And then the part that is very obvious now, housing cycle is broken. It's going to continue to weaken the overall economy. I think some of it is a question of, did we keep mortgage rates too low for too long?
Absolutely. The Fed broke housing. That was step one. Too low, like a year too long.
Why in December 2021 are we still at 3.1% rates?
And the Fed is buying mortgages. I have no idea.
And then the other thing is, did housing tell us from the get-go that this was an overheated economy? If you go back before they passed the last stimulus package, March 2021, home prices were up 14% year over year.
Yeah.
And we've only had a few readings that high.
And two of them were 05, 06. That was not a good time. That was bad.
And so and housing leads the economic cycle.
Exactly.
And so I think we were already in a good growth cycle.
It was flashing yellow and the Fed didn't
I
listen.
think the Fed not backing off, I think, and this part, is very disputed, but Larry Summers agrees with it. The additional stimulus, I think my belief is that we cut the business cycle shorter than it would have been.
I agree.
I think we had a good long growth cycle coming in, and I think housing told us that. Housing's telling us now that this growth cycle is over.
Yeah.
Prepare for the next one.
Yeah. I have one last question because I didn't know I would get here, but this is so much fun. I put out a video in my playlist under the whiteboard session talking about the most important economic question. I don't have the answer, but I'm going to try to describe it to you. So as you know, CPI came in last month at 9.1. That's a problem. What I am seeing is a huge divergence. There are people like Kathy Wood who talk deflation, bullwhip effect, all of these things, and they're seemingly acting like more than half of that 9.1 is just going to mysteriously fall away. Supply chain's going to get fixed, deflation's going to take over, and suddenly we get back to 4%. 4% is a lot easier to fight than 9%. I think we can all agree with that. That's one side. And those are the people that are buying the dip in the stock market. They're loading into crypto and all of this stuff, which again, after a second rate rise, that went up yesterday. Go figure. Then there's people in the camp like, okay, we will have some bullwhip effect, some deflation, but maybe that's only 2%. So if you're fighting 4%, you go so high. If you're fighting 7%, you go higher. The big question for me is, I don't know what's sticky, back to use your word. And it feels to me like wage inflation or wage growth is underreported, because when I look at the wage numbers, they're not taking into account the Great Resignation. I was a hiring manager for 20 years. And when I hired from a competitor, they got 20%. But as I understand that number, that's not included. It's simply, hey, I paid you $20 an hour. Now I'm paying you 22. That's a 10% wage inflation. The Great Resignation, changing jobs, changing careers, not counted. So I think there's a lot more wage growth that's being underreported. And thus CPI is far stickier, in my opinion.
Yeah. And so I'll get back to that question, but that brings up a good point. And I said coming into this year on Twitter that my biggest question mark with housing is actually income data.
Yes.
Because I look at it and we're at like a 4% is what the Conference Board has. And there's other numbers. BLS is like 4.8. But then I go state by state at some of the payroll numbers. North Carolina, I found 9.6.
Wow.
If that is true and that income is underreported or it's delayed, that means that the housing market is less detached from fundamentals than we
exactly my point. This affordability problem maybe is not as bad as people are thinking.
And so I would love, and there's only a few that go back all the way to the 70s, but I would still like to spend more time looking at the 70s, looking at the income data, and seeing how housing and income related, and if there was the lag on the income side. But if income growth is much higher than we think it is, then the housing market is healthier than we think it is.
And more importantly for me, back to the question, inflation is going to be higher and stickier, because higher wages underreported means people buy more stuff.
Yeah. Yeah. And the thing with inflation is I'm hesitant to make any predictions with inflation, because, part of it is it's a little bit of a Pandora's box, and it's been opened.
Oh yeah.
But the Fed knows that too. And they know their lessons from the past. And that's why I'm a little confused by the people who don't think it's a recession coming, because the Fed, even if it doesn't think that inflation, the Fed, everything in history tells the Fed to attack this harder. Like the risks of underdoing it are worse than overdoing it.
Exactly. And I don't think the market gets that. People have gotten used to the Fed put. We had 40 years of the Fed put. The market cries, the Fed comes in. We haven't had inflation this bad in 40 years. So throw that playbook away. Go back to Paul Volcker. Powell's got to go harder and longer than the market expects, in my opinion.
Yeah, and that's kind of where I've been. And every time that something comes out and people start to get a little more bullish, I'm just sticking to it until inflation comes down, until that beast has been slayed. I'm going to stay bearish on the cycle.
Yeah.
And everything that I see, the housing cycle turning over, it all aligns with history of us moving towards a Fed-induced recession.
I agree. So again, I believe the Fed broke housing. We've talked about that. I believe we are entering a housing depression. If your income is based on housing transactions, commissions, it's going to feel like a depression. I think CPI is far stickier than most because wage inflation is underreported. I do not see nominal price declines next year. This year is impossible. I don't see it next year, relatively flat. Certainly bubble markets. Lance, where can people find you and find your work on Fortune?
Yeah, if you just Google Lance Lambert Fortune, you can find my housing stories. And you can also find me on Twitter @NewsLambert.
Awesome. Thanks, buddy. I appreciate you.
Thanks.
Mhm.
Bye.